Welcome to Coffee with Citrin Cooperman. I'm your host, Meyer Mintz. Coffee with Citrin Cooperman is a video series in collaboration with Commercial Observer that features engaging interviews with esteemed real estate executives. The purpose of this series is to dive into pressing matters affecting the industry and your respective businesses. Today I'm joined by Andrew Farkas, the founder, chairman, and chief executive officer at Island Capital Group. Andrew, thank you for joining us.
Thanks for having me.
So I know we're sitting here in your New York City offices. I know New York City's been going through a lot of challenging times in the last 3 to 4 years. What are you viewing this and what opportunities are you seeing in this market?
Well, the truth of the matter is, distress always provides opportunity. Most investors will often fear distress or shy away from it. And the truth is, when there's distress, you should lean in because you should take a little bit more risk. It appears to be more risk, it's actually not. Distressed markets, you find opportunities coming in no small part from lenders who've had to exercise remedies and take back assets. Those types of opportunities are attractive because lenders provide their own financing, so you don't have to go out and find new mortgages. And the truth of the matter is, forgiveness of indebtedness is the largest source of equity capital under those circumstances. New York City has no shortage of those types of opportunities.
And what kind of relationships are you seeing that the bank is looking for when they give you those properties or when they look for someone to invest in those distressed properties?
Well, the fact of the matter is that they want new sponsors that understand the asset class, are well capitalized, and know how to deal with distress. You can't just buy an asset from one guy where the asset had 50% occupancy and just hope that that's going to change. You have to have a specific business plan. Things that you have identified, buttons you can push, levers that you can pull that will change the entire profile of the asset and create value.
So like, for example, an office building in Manhattan, I know we have a lot of them sitting around. Vacancy, occupancy are issues. Are you talking about converting it to residential or are you talking about something less extreme than that?
Well, we have not purchased any office buildings that we're converting to residential. We may begin backing some people who do. The largest investments we've made in New York over the course of the last, let's call it 18 months or so, is we bought 2 very large hotel assets. We bought the Sheraton Times Square, which we just refinanced, and we bought the Lexington Hotel. Between the two of those is 2,500 hotel rooms. We were able to purchase them at less than 50% what the previous owner paid, and that's because they were closed during COVID. That type of investment requires some fortitude, no question about it. But once again, if you lean in and you have a plan, you'll find that value is created. That's definitely happened here.
So, I mean, hotel's a unique asset class. Someone told me once hotel is like buying an apartment building and finding new tenants every single night. Is that an asset class that you looked at because of the fact that there's constant turnover, or is that an asset class you just found an opportunity and jumped?
Well, we've owned hotels in the past. We're in the process of undertaking to buy additional hotels. In New York City in particular, during COVID, north of 5,000 hotel rooms were taken out of circulation forever. Really more than that, closer to 10,000 hotels were taken out forever. These 2 assets were also Marriotts. Those Marriotts are amongst the only Marriotts in those particular corridors right now. And the truth of the matter is the Marriott hotel reservation system and otherwise provides constant flow of potential occupants. So both of those assets have had sort of average 90% occupancies from having been completely closed during COVID.
And RevPAR is creeping up.
It is above what it was pre-COVID.
That's pretty interesting. I know Manhattan's having a lot of issues. Hotels is the one bright spot, partially because a lot of hotels, like you said, are out of service, and a lot of tourists are looking for domestic travel as opposed to international.
Well, there's both tourists and business travel right now. And the truth of the matter is both of these assets are 4-star, they're not 5-star, so they appeal to a much broader range of potential visitors.
And what other markets are you looking at besides for New York? And what do you see as like New York versus other major cities like Boston and Chicago relative to the comeback?
New York is faced with its own series of issues that are unique to New York. I don't think they bear repeating. We all know what they are. Every city in the country, particularly 24-hour cities, are faced with some of the same dynamics. I think that the country seems to be moving towards what they refer to as a 4-day work week. So people liked staying home, and so they will stay home more often. in truth, if you try to make people come in more than that, they won't like the environment in which they're working. So we allow that to happen. Obviously, if all you do is a 4-day work week, or you do any kind of recycling of people through offices so they don't need permanent offices, that decreases demand for office space. And that's what's happening not just here, but everywhere.
I mean, I guess New York, to the extent people don't drive to work and people don't live close to their offices, it's a little more extreme. But do you find just companies leaving New York is an issue too, or it's more just reducing footprint?
Oh no, companies are definitely leaving New York. They're going to Florida, they're going to Texas, they're going to cities that are much less expensive, have lower tax rates, and the quality of life is greater. I love New York City. I've lived here most of my life. But again, it has some unique challenges.
And I guess one of the other things that people are talking a lot about in real estate is the interest expense environment, and partially the unpredictability of where people think it's going to be. Some people say 4% debt is gone for good, and some people are holding out a little more hope. Some people think that we're lucky at 8% now compared to where we'll be in the future. What's your kind of outlook on interest rates and inflation and how that's going to impact next year?
I think the first thing is we all have to recognize that hope is not a strategy. Right? So I wouldn't necessarily hope for anything. It's all going to be market dynamics. Most people don't remember that in the sort of late 70s, interest rates were 18%. So the fact that we've had sort of 3% interest over the course of the last decade or so, that's made people look smart, but more often than not, it helps people be lucky. And that's just true. I think 4% is a thing of the past. I would like to see things settle out at around 8. How quickly will that happen? I don't know. You know, I think a lot of the things that one can't calculate nor solve for right now is geopolitical event risk. And there's more of that whose timing and extremity is just, incalculable. And it's binary.
Yeah, and I think the black swan risk is turning into a real number now too, where there's some event that's going to happen that's been happening over the last 5 to 10 years, and we just don't know what it is. Like you're saying, geopolitical, COVID was another one. You have all these weather extremes all over the world, and because of the national and international impact of all this, it's like everything's impacting the whole world.
Absolutely true. And capital markets right now are more unusual than I've seen them in 40 years. Everything takes longer, everything's more difficult, and of course everything's more expensive.
And what are you seeing underwriting standards? Are people actually looking a lot closer when they give money out or when they look at
Absolutely. That's not to suggest that people were not doing good underwriting before. I think that right now, though, everything's under a microscope.
I know we talked about hotels. What other asset classes are you looking at? I know a lot of people, for a period of time, were big on industrial. A lot of people, for a period of time, were going down south and looking for, just opportunistic apartment deals. I think a lot of that's done. What kind of areas are you guys looking at?
I'm not sure I agree that apartments are done. We've been buying a lot of apartments. You have to remember that my personal history is very much in the apartment business. When I started Insignia in 1990, we grew that business to a business that included the ownership of close to 350,000 apartments. So, apartments are us, if you will. New York City still has apartment opportunities, and sort of secondary cities in the South and in Texas and in the West Coast also have opportunities still. Sort of workforce type of housing is that at which I think people should be looking.
Oh, that's very interesting. And for we're going into now to 2024. What's your kind of outlook for 2024? Are you optimistic? Are you, I guess hopeful is not the right word, but are you thinking that things will start normalizing wherever they normalize at least?
Not in 2024, which means lean in.
That's very good. Well, thank you for joining us. Hopefully we'll see each other soon.
I'd like that. Thanks very much.